In recent days, Tokyo has been jolted by the sudden collapse of the yen and an alarming escalation in tension with Beijing, a conflation of currency shock and geopolitical confrontation that is reshaping Asia's financial contours. The backdrop is telling. Japan's newly installed Prime Minister Sanae Takaichi took office on 21 October 2025, becoming the first woman to hold the post. Meanwhile, in Beijing, Li Qiang assumed the position of Premier of the People's Republic of China on 11 March 2023. The immediate trigger of the crisis was multiple, but the most visible sign was the yen's rapid depreciation to multi-decade lows. Japan's economy, already burdened by years of deflation, high public debt reaching about 250% of GDP, and ultra-low interest rates, found itself open to a currency rout. Normally, such a slide might merit a routine intervention by the Bank of Japan or an alert from Japan's finance ministry. But this time, the backdrop is far broader. Japan is being drawn into a growing contest with China, not only over currencies, but over security and regional order. From Beijing's side, the approach appears deliberate: sharp diplomatic pressure, economic measures targeting Japanese interests, and an unmistakable signal that China will no longer remain passive. A report this week notes that China has retaliated against Japan's new leader with harsh words and economic pain, including cancellations of Chinese tourist trips, suspension of key cultural exports, and threats against Japanese firms operating in China. Tokyo, for its part, is trying to pivot. Takaichi's government is signaling that Japanese defense and economic strategy will now lean more heavily on alignment with the United States, address China's maritime and military posturing, and re-examine long-standing assumptions about currency and trade policy. But as the economics crash landing accelerates, the window for maneuver is narrowing. Japan's currency woes are deeply structural. The BOJ's long era of near zero, even negative interest rates, combined with persistently weak inflation, has made the yen a target for speculative capital. According to recent data, the real effective exchange rate of the yen has fallen to its lowest since 1970. In July 2024, the yen had already hit a 37.5-year low, but the slide has since accelerated. What adds urgency now is the convergence of Japan's external exposures. A large current account surplus has narrowed, public debt is extremely high, and now the deflationary forces have shifted toward devaluation. Japan's economic narrative is no longer riding a weak yen for exports, but rather surviving a weak yen under import stress. In this environment, the yen's collapse triggers immediate pain. Import prices, particularly energy and raw materials, soar. For households and businesses, that means higher consumer bills, squeezed profit margins, and growing fragility. The currency rout also sparks questions of financial market stability. If the yen is perceived as under attack, capital may flee, bond yields may spike, and global finance may spill into broader contagion. What makes this episode far more than a domestic Japanese currency story is the way Beijing is overlaying it with strategy. China's broader aim of pushing for an alternative financial architecture, a push laid out in academic studies of RMB internationalization, suggests that China sees its economic weight and diplomatic muscle as tools to challenge what it views as the dollar-dominated G7-led financial order. Earlier this year, the Group of Seven G7 reaffirmed its warning against excessive volatility in currency markets, a standard signal Tokyo interprets as granting it the latitude to intervene when the yen falls too fast. Yet, what is occurring now is not simply Japan stepping in, but China applying pressure that complicates Japan's space to act. Beijing appears to be using the currency weakness in Tokyo as leverage. It is signaling that if Japan steps too aggressively, financially or militarily, China will retaliate, including through trade, tourism, investment, and possibly more overt diplomatic or security measures. Prime Minister Takaichi inherits a difficult mix: a rapidly weakening yen, geopolitical pressure from China, a domestic electorate impatient for growth and security, and limited fiscal monetary firepower. Her government has indicated that it will place higher priority on defense spending and economic security. At the same time, Tokyo must decide whether to deploy its FX intervention capacity, act jointly with G7 partners, or accept further depreciation in the yen. But this moment differs from past currency shocks. In previous decades, Japan could rely on the BOJ with little overt geopolitical overlay. Today, the intersection of economics and strategy means Tokyo must think about currency action in the context of China's posture and the risk that intervention could provoke China further, energize market speculation, and invite retaliation. Among key statements, a Japanese currency official recently warned markets that Tokyo was ready to step into the market any time to counter speculative yen moves that hurt the economy. In Beijing, when asked about a meeting between Premier Li Qiang and Takaichi on the sidelines of the G20 summit, the Chinese Foreign Ministry spokesperson stated, "We urge Japan to behave with proper self-restraint." These remarks underscore the dual nature of the threat, finance and diplomacy at once. This crisis is not just about Japan and China. It sends ripples through Asia's supply chains, foreign investment flows, and broader strategic alignments. First, many Asian economies look at Japan as a stabilizer. A sharp Japanese currency crisis could lead to cross-border capital flight, rising interest rates regionally, and even threaten financial stability in emerging Asia. Second, China is signaling to its neighbors economic coercion is now part of Beijing's toolkit. Japan thus becomes a test case if China can punish Japan without US intervention. What might it do to smaller Asian states? Third, within the G7 and global finance architecture, Tokyo's weakening position matters. Japan was once central to Asian financial stability. Now a failing yen raises questions about its role and whether other currencies or the RMB might take a larger place in regional settlement. Scenario 1, Tokyo intervenes. If the BOJ or Japan's finance ministry steps in to buy the yen or sell foreign reserves, it may arrest the slide temporarily. But any visible action will likely draw China's ire, especially if framing becomes about Japanese defense of the yen tied to security rhetoric. That could escalate countermeasures. Scenario 2, Tokyo holds back, allows depreciation. The government might accept further yen weakness, shift policy to protect import-sensitive sectors, and rely on pressuring domestic inflation resilience. That path is risky. Inflation may stoke public discontent, and Japan may lose credibility on the global stage. Scenario 3, a negotiated pause with Beijing. Japan could seek to engage with China not just on trade but on currency stability. But Beijing's current posture suggests it prefers pressure than dialogue. A breakthrough would require Japan signaling reduced alignment with the US or a softer stance on Taiwan or military posture likely politically unacceptable in Tokyo. This juncture marks a deeper structural shift. The yen's collapse is symptomatic of Japan's long-term economic fatigue. Japan may no longer be able to lead from the sidelines in Asia's economic order. Meanwhile, China is acting not just confidently but coercively. It views the global financial system as part of the geostrategic competition and is using its growing heft to reshape it. The era of uncontested G7 financial dominance may be waning. If Japan appears weak, others may recalibrate their alignments. If China is able to manipulate economic and currency pressure with few consequences, the precedent will be set. The path of Japanese bond yields. If yields spike, Japan's debt servicing could become unsustainable. The BOJ Finance Ministry announcements, whether they intervene subtly or visibly, is a key signal. China's next responses, whether cultural, trade-related, financial or even military, Beijing's actions will show how far it is willing to push. Regional reactions, how South Korea, ASEAN states and Australia respond to the spillover from Japan's crisis. G7 coordination, whether the United States, UK, Canada and others stand by Japan or treat this as a bilateral issue with China. Japan finds itself at a crossroads. The yen's collapse is no longer just about domestic policy, but is entangled in a broader strategic confrontation with China. Prime Minister Takaichi's government must navigate a narrow strait, defending Japan's currency and economy while avoiding igniting a deeper Sino-Japanese conflict. How Tokyo acts will reverberate through East Asia and the global financial system. The questions now are not just about when Japan intervenes, but how China responds and how the rest of the world reacts.